Thank you for joining us on our MyWealth webinar on retirement planning with Mackenzie Investments. My name is Jeff Hunter, and I'm a Senior Investment Associate and Associate Portfolio Manager with the Townshend, Somani and Hunter Group at Canaccord Genuity. Also on the line are our Senior Investment Advisors, Dave Townshend and Raheem Somani. For more information about our team, our process, and our exclusive MyWealth Global Portfolios, please check out mywealthmanager.ca. This call is being recorded, so please make sure to check your email in the coming days for replay information. Today, we are joined with Mike Evans, Tim Brisibe, and Mark Russell of Mackenzie Investments. Mark, Tim, Mike, thank you for joining us. We're really excited. Obviously, there's a lot of interest in this space and in this topic right now. Why don't you tell us a little bit more about yourselves and your roles with Mackenzie?
Great. Thanks, Jeff. I'm just going to take a couple of minutes here just to introduce our guest speakers. Both Tim Brisibe and Mike Evans have a number of years of experience. I'll start with Mike. He's the longest one, so that we'll get that one over with. But Mike's been in the industry working hard on behalf of Canadians for over 30 years. Mike is a VP of our national initiatives at Mackenzie Investments, focused on some of the growth pillars in the industry, one of which is retirement income. And we're going to delve into that a little bit deeper. Tim Brisibe has been with us a number of years and in the industry even longer, pushing a couple of decades. Tim is a director of our tax and estate team. He is a member of our tax and estate practitioner and has a lot of educational background in the legal side of things, with some specialization on trusts and estates from a knowledge perspective. So with that, Mike, I'm going to hand things over to you and maybe walk us through what we're going to be focused on over the next 30 to 40 minutes. Over to you, Mike.
I'd be happy to, Mark. Thank you for that kind introduction. It's true. I've got lots of gray hair, been at this a while. Jeff, appreciate the invitation. We're here to talk about retirement strategies. So why don't we advance to that next slide, Tim, and there's the standard disclaimer. And this sort of kicks it off. As Mark described, I work on national sales initiatives at Mackenzie. And one of those top priorities is really our focus on retirement and the work we do with advisors across the country on retirement preparedness. And as we have a retail audience here, folks concerned about retirement and their preparation for it, I thought I'd kick things off with a bit of a highlight. We've done lots of work over our 54-year history at Mackenzie, working with advisors and the retiring clients that they're servicing. We've done a lot of survey work to gather some insight into what's on the mind. What are the top concerns of Canadians, those in retirement today or advancing to retirement tomorrow? And this is kind of the lens through which we're gonna talk today. So here's the 6 top concerns that investors have shared with us, retirees and pre-retirees from across the country, and some of the things we take into consideration when working with folks thinking about retirement and preparing to make that journey. So number 1 is this idea of purposeful retirement. What are you going to do in retirement? How do you achieve fulfillment? What's retirement look like is a major concern for many Canadians. When it comes to their finances, the single largest number 1 concern is running out of money. So retirement income validation is critical. We're going to focus in on a strategy for answering the one key question: am I going to be okay? Right? And what am I going to be okay? What does that mean? That means, do I have enough? How much can I get? How long is it going to last? How much tax am I going to pay? And what's going to be left over at the end? So if those issues are ones that are paramount to you, you're in the right place, and we're going to set about forging a path to answer those questions. So income validation, number one concern. Canadians also express consistently a lack of knowledge about their tax profile in retirement. I think we are all pretty familiar with how we're taxed while we work, but what does tax look like in retirement, and what are those various sources of income? And how are they taxed is a bit of a mystery. We'll try to demystify some of that for you. Estate and legacy planning, right? At the end of the day, it's critically important that everything comprehensively come together and ensure that the least amount of tax is paid, particularly at estate time. and retirement income planning. It's interesting. In retirement, people can expect to receive income from a variety of different sources, and upwards of 10 or more in the case of couples. So understanding how those income sources work together and what they're designed to accomplish is critically important. In the survey work we've done, it was interesting to note that Canadians tended to have an idea around retirement investing around safety rather than growth. We think that's a bit of a mistake, and there needs to be a balance struck between those elements. But 71% indicated that safety was the primary concern. And then at the end of the day, Canadians quite naturally are very fragmented. I describe them like squirrels preparing for winter. They've got nuts buried all over the yard. You may be the same, with assets at the bank, insurance company, financial advisor, broker, planner. You may even be managing some money in your own discount account. At some point, there needs to be a consolidated view placed on all of those aspects to deliver the objective that you're looking to achieve in retirement. So these are some of the things that are on people's minds, regular Canadians like yourselves that are on the journey to or in retirement currently. Flip to the next page, Tim. We'll have a look at some of the things we want to talk about today. Tim's going to take us through some tax strategies for retirement income. These are some of the pillars that we rely on when constructing that retirement income flow. And at the end, we're going to close with a case study. I'm going to take you through an example of a couple. They're business owners. They've got a variety of different income sources, and the same questions that many of you have. Are we going to be okay? Do we have enough? How much can we get? How long is it going to last? How much tax are we going to pay? And what happens at the end? So we're going to try and tie it all together at the end with an example and an illustration of what we hope to accomplish for everyone on the line. So Tim, why don't I throw it over to you? You can take us through some of the tax strategies, and then we'll come back around to the case study when you're finished.
Sounds good. Thanks, Mike. And again, welcome to everyone that's on the call. And we do appreciate the fact that you've taken time to attend this webinar. It's pretty significant, just as we've all talked about, right? And so the next 20-25 minutes, I'm going to walk you through some of the agenda items that you see here. And we'll close again. I'll hand things over to Mike, and he'll walk you through a case study, if that would crystallize and provide a response to the question, am I going to be okay at retirement? So we'll look at CPP OS and the decisions around when should you take this. There's a wide spectrum of age, right, as to when we take CPP or OS. Income splitting, there's such a thing as income splitting. Some of you might be using this strategy just now, and others might not. So I'll introduce you to some of the advantages of income splitting. And also we'll talk about the conversion of RSPs to RIF. As we know, December 31st in the year that you turn 71, that's when you're required by law to convert your RSPs into RIFs. And there are a couple things to keep in mind with respect to that. Tax-free savings account, this is a wonderful tool that we have at our disposal. And this also plays a pretty important role, right, in retirement. And so the key question again, CPP and OS. One is based on what you put in, which is CPP while you're working. And the other is just simply turning 65. You're a resident of Canada, and there are a couple other criteria to qualify for OAS. So these are benefits that you would receive based on qualifiers, right? And so for CPP, you could apply prior to age 65, but the optimal age at which you'd receive the maximum CPP benefit would be 65. And for 2023, that amount is approximately 1307. That would be the maximum that you'd receive at age 65. Now, some folks might want to start collecting CPP at age 60 because it's allowable, right? And I remember speaking with a client many years ago, and she couldn't wait to turn until she turned 60. And she wanted to start collecting CPP at age 60. Mind you, she could wait to 65 and collect the maximum at age 65. But she had a question and a concern. What she said to me was that she didn't trust the government. You know, and people come at this from very different perspective, right? I don't trust the government. I can't wait until 65. What if it's all gone at 65? So I better start collecting at age 60. There are consequences to that. Now we are assured that the CPP will be around for almost the next 100 years. So we can rest assured that we're fine. But then there is a penalty up to 36%. So based on the example that I gave, the maximum at age 65 is 1307. If you started collecting at age 60, you're down to 836. And the penalty is $471. That would be the shortfall. And that's fine. There are reasons for doing that, and we'll go through some of the reasons, right? OAS, you can start applying at age 60, start collecting, but you can delay and defer. Same with CPP, defer to age 65 or defer even to age 70. And there is a premium. Just like there's a penalty, there is a premium for CPP as well as OAS. OAS up to 36% premium, which would be an advantage if you were to delay. CPP, you're looking at 42% premium, which again is an advantage if you were to delay. But then there are reasons for either side if you wanted to collect early or if you wanted to collect late. So we'll go through just a list of some of those things that would factor into your decision making with respect to when to take CPP or OAS. The first one that you see here is life expectancy. I remember I just moved into a relatively new home. And so we had our 60-day inspection just the other day. And the fellow that came to do the inspection, we got talking. His sister died in the middle of COVID, kidney issues. His dad had died many years prior, kidney issues. His grandfather died, kidney issues. And so he's concerned. He wanted to leave the inspection early so he can go for certain tests. He's concerned that he might not live to age 70, right? And so if there is a family history of certain ailments, it might mean that there is the possibility of shortened life expectancy. Of course, we don't know, but then we can tell. There are things that might suggest that it's best to take it early if there is a shortened life expectancy. Now, if the life expectancy is longer, then the idea would be it might serve you better or best if you took it later, right? And the stats show that generally speaking, it is better to take CPP later as opposed to earlier. So that's the first thing, life expectancy. The next thing, I'll just speak to this very quickly. What you have here with respect to life expectancy would be, just like I mentioned, you have 836, right? So if you start taking it at age 60, it is at age $836, right? If you begin at age 65, 1307, and every age in between 60 and 65. The next row that you see there, the cumulative CPP earned prior to age 65, in this case is approximately $50,000, right? But we have done the math here to determine, based on the Canadian Society of Actuaries, they came out with a study. And the study proves the point that it is better to take it later as opposed to earlier. Now, what you see there is break-even months and break-even age. So this is called the break-even analysis, right? If you believe that you're going to live past age 73.9, 73 years and 11 months, it is probably best for you to start taking CPP at age 65. The cumulative benefit, right? It would outweigh if you started taking it at age 60. So the graph that you see here, if you start at 60, it appears that you're well off. That's the blue line that you see, right? And the inflection point is the 73.9 years. So it's approximately 74 years. That's when the orange line, if you start at 65, takes off and takes over, and you see the benefit right to age 100. And so the idea and the suggestion is, if you do not expect a shortened life expectancy, it is probably best for you to take CPP at 65, because the benefit at 65 and beyond outweighs the advantages that you might perceive if you started taking it at age 60. The next point would be consume or invest. For some people, I read an article just the other day. One of the national banks came out with a survey of 1,500 Canadians, right? And one of they asked a bunch of questions. One of the questions was confidence, right? 44% of those that were surveyed, they said that they were confident that their savings would help them and meet their retirement needs. This is down from 54% when the survey was done in 2020. So we lost 10%, they've lost confidence, right? And 60% of those that were surveyed, they had problems with inflation that we see this year and last year, as well as the state of the economy. They're thinking, maybe I can't make it. You know, we're going to help you answer those questions. Now, another portion of this survey was folks are literally using their income to purchase grocery as opposed to saving for retirement. And so there is a balance. Where this article ended up is where you are right now. Speak with your financial advisor. Speak with your investment professional, because they are equipped to help you determine and make sense of the chaos that we see in our world today. So for some, they would consume, right? For others, they probably don't need or require the funds, the CPP, the OS, and certain other funds, so they would invest. And again, based on the break-even analysis, the study that we've done, it is probably better if you don't require the funds to further your lifestyle immediately to invest, beginning at age 65. Again, similar to the break-even analysis that we showed you earlier. Other reasons would be cash flow, right? Are you still working? Do you have rental income from investment property, and so on and so forth, which again informs the fact that whether or not you need the resources, or if it'll be best for you to invest your CPP or your OS pension. Another thing, and I'm sure you've heard the dreaded term clawback, right? So OS clawback, it technically called the recovery tax. If you are at a certain threshold, then the OS pension that you receive would be clawed back by the governments. And so you want to be able to manage your income. That way you can take advantage of the maximum OS pension. If one were disabled and receiving the disability pension from the CPP, as soon as you turn 65, then you're automatically enrolled in the regular CPP pension. Again, like I said, at age 60, 836, or at age 65, 1307. A concern has to be tax. What about current tax rates as opposed to future tax rate? We do not know if tax rates would go up. They've gone up a little bit over the past few years. That would inform whether or not you take your income, you invest your income. The idea becomes, upon retirement, you're expected to be at a lower tax bracket. And so that would be the general planning with respect to some of the rationale behind either taking it now or saving it up until later when you're at a lower tax bracket. So some of the strategies, right? Income splitting. This is a term that you may have heard, and some of you may have even used. An income splitting strategy. A very common one would be the spousal RSP, and we'll talk about that. And so this essentially means that I am married and I earn more than my spouse, for example. I want to share the tax burden. I want that family member to share the tax burden so my tax liability is not as high as it is right now. So what I'm doing is that I am moving assets into the hands of a lower income family member. That way we share the tax burden. But the rules have something to say. There is a distinction between tax evasion and tax avoidance, right? And the government has provided for in the rules for us to share the tax liability with members of the family. But there's a way to do it, right? If it's not done right, there is something called attribution. I earn higher than my spouse. I shift assets to my spouse to invest. But if I don't do it properly, the income that my spouse earns from the assets that I've shifted to them would be reported by me and taxed in my hands, which defeats the entire purpose if it's not done right. And so what we want to show you is how can you do this right? And that way you can split the tax burden from a higher earning spouse to a lower earning spouse. Number of opportunities, right? This one called CPP sharing. So if you're at that age, you can share the CPP pension. And again, it just transfers the burden of the higher earning spouse to the lower earning spouse. The other one would be what's known as eligible pension splitting, up to 50% of eligible pension. And this could be RIFs or locked in a pension plan, lifts, and so on and so forth. So it is possible at age 65 to split pension income up to 50%. Again, the idea is to shift the tax burden from the higher earning spouse to the lower earning spouse. That way, there is more money within the family to further your retirement. Spousal RSP is one, right? You've got RSP room, the higher earning spouse. You set up an RSP for your spouse, it's the spousal RSP. You make contribution based on your room into your spouse's RSP. The idea again is that when it is time to start withdrawing income from the registered plan, your spouse who is at a lower tax bracket will be taxed at that bracket. And so you're effectively splitting income at that point. Very quickly, it's the idea that if you were to make contributions into your spouse's, into a spousal RSP, just to be careful not to withdraw, for a spouse not to withdraw money from the RSP within 3 years of making the contribution. Otherwise, the rule, attribution, the taxes will be attributed back to you, which defeats the entire purpose of income splitting. The TFSA is a wonderful tool, right? I've come across folks that have room up to $80,000 and they don't have a TFSA. I think it is great. And we'll talk about one of the purposes that a TFSA would serve if you didn't require your CPP OS pension to further your retirement lifestyle. Perhaps the TFSA would be a great place for you to invest. And finally on this, I'll just say this really quickly. If you own a business and your children or a spouse is a shareholder in the business, some folks have set up what's called a CCPC, Canadian Controlled Private Corporation. So this is your small business. And so you got a 19-year-old or a 21-year-old that attends university. They're shareholders in the business. There are certain exemptions that they should pass. If that's the case, you pay them dividend income. If your income is $300,000, for example, you could pay your child $30,000 you could pay the other child 30, you could pay your spouse 40, and your income has reduced from 3 to 2. And the other members of your family are receiving dividends, as I've described, which again is sharing the tax burden as a small business owner. That would be another way to income split. And finally, number 5 on your list is what's known as the prescribed rate loan. The prescribed rate loan, historically, I'd say historically, the past 2-3 years, it's been at 1%. And so this is the prescribed rate. Right now, as you're aware, the rates have gone up. And as a result of the rates going up, the prescribed rate is at 4%. But the idea, again, is if I had $1 million and I'm at the top tax rate, a bracket, what I want to do is invest $1 million, but then it means that I'm paying more tax. And so what I'll do is to loan the $1 million to my spouse who earns less, and they in turn would invest $1 million. The expectation is that they would have a rate of return north of 4%, which makes the strategy work. They pay 4% interest rate to me prior to the end of January of each year, and they would write off that 4% because it's an interest rate that is as a result of investment that earns investment income. The idea, again, is we are sharing the tax liability in the family. I've got a few more slides to go, and I'll turn it over to Mike. So we're talking now converting RSPs to RIF. I mentioned earlier that December 31st in the year that you turn 71, the conversion has to happen from RSPs to RIFs. Number of things to consider. You can base the RIF minimum payment. So you turn 71, the RIF factor at age 71 is 5.28%. So you're now required to withdraw a 5.28% from your RIF. If your spouse is younger, you can base that withdrawal time or age based on your younger spouse's age, which means that you can delay receiving your RIF income based on your younger spouse's age. We talked about pension income splitting, and you can do this with your RIF income if you are 65 or over. Beneficiary designation is an important thing to consider. So what I'll say here is that upon death of the one spouse, there is a tax deferred transfer or rollover of your RSP or your RIF to your surviving spouse, and there are no tax consequences. So let me put it this way. Let's assume your RIF is at $1 million and you passed away. You didn't have a spouse, or your spouse has predeceased you. You didn't have a disabled child or a minor child. That $1 million RIF, CRS 6 sees it as income, and it'll be taxed, and the tax liability will be $480,000, which is the top tax rate in Alberta, right? But if there is a spouse, there is a tax deferred rollover of your RIF or your RSP, so you are deferring tax until the surviving spouse passes away. Something to consider is this. I remember a case that we had where the husband named his sister as the sole beneficiary of his RIF, and he died. So based on what I've just suggested, it's if he had named his wife, she would have received the RIF tax deferred. But he named his sister, and there would be a tax consequence implication that his estate would be responsible for, right? So we need to be careful who we name, and this is where you have a conversation with your advisor to determine what the best path would be. Finally, on this point, there is a strategy around a final RSP contribution. I want to go through this very quickly. So again, December 31st, in the year that you turn 71, you're required to convert your RSPs into RIFs because you'd have to start receiving income. But in this year, in 2023, you have earned income of $150,000. You are entitled to contribution room in 2024 of $27,000, 18%, right? But you don't have an RSP in 2024 because your RSP has been converted to a RIF. No, you can't make any contribution any longer. So there can be a one-time contribution and even over contribution this year prior to December 31st of 2023. The catch now is that there is a penalty, but the government allows $2,000 over contribution without a penalty. So the difference now becomes $25,000. There is a 1% penalty for each month that the over contribution is on the books. And in this case, for that month, the penalty is $250. January 1st of 2024, the over contribution disappears, a brand new year. And what that means effectively is that there is, based on the numbers that you see there, we have averaged this out to 43% across Canada. And you're looking at approximately $12,000 of tax savings based on that one-time contribution into your RSP just prior, before December 31st, that the conversion would take place. The TFSAs in retirement, this is a wonderful tool, right? It is an estate asset. It is not taxable. As we know, upon death in Canada, there is something called deemed disposition. And what deemed disposition simply means is that the CRA comes calling. This is generally when we incur the largest tax liability of our entire lives at death. But TFSA is protected from that. You're not paying any tax. There is more that goes to the beneficiaries of your estate, which is why we term it an estate asset. You can redirect OS and CPP payments that you do not require into the TFSA so long as you have room and it doesn't impact income tested benefits. So the tail end here, before I turn it over to Mike, we're looking now at order of asset withdrawal, some of the tax implications of those benefits, layering of income, and also RSPs and RIFs exit plan. I'll speak to these and then I'll turn it over to Mike. These are just to bring to your attention some of the tax credits that are available to you if you're 65 years and older. And if folks are preparing your taxes for you, you need to make sure that they account for all of these non-refundable tax credits that are due you, which effectively helps you to lower your tax liability. Finally, layering of income. What this pyramid suggests is if you are a shareholder of a private company, there are ways that you can receive tax-free dividend, tax-free income through the corporation, right? So all we're saying here is that there are more tax-efficient ways to receive income, and there are less tax-efficient ways to receive income. This is where the value of advice is meaningful and impactful, whether or not you can mix both or one over the other. RIF exit plan, part of this that bleeds into order of asset withdrawal, right? Should I deplete or draw down my RIF? Because upon death, the RIF becomes income and the tax liability is huge, right? What about redirecting some of the RIF income into your TFSA and so on and so forth? If you receive the income, perhaps it impacts your OS pension and there is a clawback. Again, this is where you have conversations with Jeff, with Dave, and with Raheem to help you coordinate and organize how this will look like. I'll turn it over to Mike and we'll take questions at the very end.
Great job, Tim. I think what you did was really highlight the cross-section of numerous strategies that can come into play at and through retirement. And you and I have had the pleasure of working on a lot of different cases to analyze situations and optimize some of those. You know, you and I have, I know, had questions with advisors and the clients they work with about when is the right time to take OAS and CPP. Should we defer? Should we not? So many things go into those conversations. Anyway, so here's an example of a type of case that we would work on in collaboration with an advisor. So if you're listening to the strategies Tim talked about and wondering what impact those might have on your case, and you're thinking, I'd love to see whether or not I can accomplish what I'm looking to accomplish in way of being okay in retirement. Here's an example. We use Tom and Gina. That's a bit of a pun coming from one of the members of our tax and estate team, Frank DiPietro. He's a big Bon Jovi fan, so living on a prayer, Tom and Gina. And it's an example of a business owner case, which we commonly see. And Tom and Gina are in their mid to early 60s. Tom and Gina own 95% and 5% respectively of a company, TG Incorporated. And Tom has always been actively involved in the business. And Gina was only really added as a shareholder for income splitting purposes. And this was prior to the new TOFSI rules coming into effect. You know, she never really made any contribution in capital or labor to the company. And they're both now retired and wondering, hey, what's the most efficient way to take our income in retirement? Thinking about all of the factors Tim talked about and how those work together for this couple and through time is the analysis that really needs to take place. You know, some of the key factors here, in our case, Tom and Gina are Ontario residents. Neither Tom or Gina have a DC plan, defined contribution plan, or LIRA, but Gina does have a defined benefit plan. I'm going to show you the asset breakdown next. She gets about $20,000 a year in income from that. Tom is currently collecting CPP and will take OAS soon. Gina also is going to be starting her CPP and getting roughly $14,000 at age 65. Now, they're also looking at things like downsizing their principal residence, moving to the cottage, investing in a condo, doing whatever they do at that stage, and pulling some capital out of their principal residence to bolster their goals and objectives in retirement. Now, I mentioned that idea of the question, the big question, are we going to be okay? So Tom and Gina are wondering, are we going to be okay? Their version of okay is $120,000 a year in net after-tax income. And the question they have is, do the assets we have support it? So Tim, go to the next slide. And that's just a quick breakdown of some of the financial highlights. You'll see they've been contributors to their RSP programs. They get roughly $600,000 across the two of them, actively engaged in saving in their TFSA, 175 there. They've got some non-reg assets of roughly 300,000. And then they've got roughly $1 million in capital in the corporation. And the question is, well, what does all this add up to? How much can we get? How long is it going to last? How much tax are we going to pay? Right? What happens at the end from an estate perspective? And those are the questions we think are critically important to engage with your advisor and to come up with a strategy to optimize the right form of net after-tax income. The next slide shows the importance of order of asset withdrawal and the impact that can have. Part of the output that we'll come out with analyzes what's possible. It's really a discussion of possibilities, as I like to phrase it, where we take all of those factors, those various inputs, and the various strategies that can be deployed in retirement to maximize your income, minimize your taxation, and maximize your net estate value. This is an example of the same set of facts, Tom and Gina, with the assets you just saw, and 3 different approaches to withdrawing capital from their plan. And our goal is to put together the optimal blend. So we test a variety of different assumptions. The worst of the three was a registered deferral strategy, kind of deferring registered assets to the very end. The second runner-up was a registered drawdown strategy, primarily focused on the registered assets first. The winning strategy in this version had us employing kind of a hybrid strategy where we took some open money first and then went to the RSP in order to provide that optimal net after-tax income. The difference between those, the suboptimal, the red strategy, and the green, in this case, is $124,000 in taxes payable at estate time. That we refer to as the value of advice. Now, I can tell you, Tim and I have analyzed dozens of different retirement cases, and we see a variety of different outcomes. And I can tell you that oftentimes we'll see the difference between a suboptimal and optimal strategy for order of asset withdrawal being many hundreds of thousands of dollars, 2 or 3 hundreds of thousands of dollars easily. And in a case we recently analyzed, it was north of 600 on a case of similar size. So getting this right is critically important, and it's reflective of the importance of the value of advice. The next slide, Tim, I think tells an interesting story. Some approach their situations not really knowing how much they can receive in retirement. So one of the important components of the output that we engage in is this analysis and solve for not just your version of what you're looking for, but also an assertion of what we believe the maximum sustainable from your asset package is. So from what Tom and Gina's breakdown of assets illustrated, the analysis came up with almost $150,000, $148,000 in net after-tax income that was possible. Of course, their version of happiness and we're going to be okay was 120. So it was a very successful case. And if you're sitting there wondering, hey, are we going to be okay? And I would like to see a version of this output that analyzes our situation, our circumstances, and our strategies for income splitting and tax reduction. I think that's exactly why you want to deal with Jeff, Rahim, and Mark, or not Mark, John, and or Dave, pardon me. And so this is what we should do at this point is look at coming back around to running that analysis. So I know we may have questions, Jeff, from folks on the line. Do you have any that have come in as a result of our conversation?
Couple one, and for the audience there's a little Q&A button. If you have any questions, just feel free to type them in and we'll ask them on your behalf. First one is, if you start taking CPP at age 60 and then later decide that you don't want to take it, can you change your mind and start collecting at a later date?
Tim, that one's for you.
Yeah.
You ever see anybody turn it on and or off?
I haven't seen. Generally, people start collecting, they just keep collecting, but then you can stop if you wish, right? Because the optimal age, the age at which you qualify for the maximum is age 65. But generally, when folks start collecting, they just keep collecting. And that's generally how it's worked in my experience. Yeah.
If they did take it and then turned it off, would that impact the amount they receive later? I'm assuming it probably would.
It would,
because they've taken some out, right? But
it would, yeah.
Does appear they have that ability, but we don't see that happen very often.
No.
Another one, in the break-even analysis, does it consider investing the extra money and the opportunity cost with that, or inflation?
Yeah, that's right. It considers investing the difference, right? So if you start collecting at age 60, right, for example, and you're saying to yourself, I'm going to invest, right? And then we're looking at age 65. That is the optimal age in which you start collecting 1307, which is the highest, the maximum that you can receive. And then we further that, right? And we look at the break-even age for investing your CPP. If you believe that that age is 74 years, a 74 point, if you believe that you're going to live past age 74, it is best for you to start collecting at age 65. Again, the idea being that if you collected at age 60 and you invested it, you are well off, better off, even based on the rate of return. So analysis has from 1% up until 6%. And we want to compare apples and apples, right? So you start collecting at age 60, you invest the difference, and you start withdrawing, right? At the same time as this other person is collecting their CPP maxed at age 65, 1307, right? In the long term, you are better off collecting at age 65 as opposed to investing. Now, having said that, I also suggested that if there is the likelihood of certain life expectancy, you're probably better off collecting and you're not investing this because you're just going to consume this. If you wanted to invest, maybe you're looking at this, you have an eye toward an estate for your family. So you are putting money away and putting money aside. Yeah.
But having the ability, Jeff, to actually not spend and save that money and invest it makes a huge difference.
Yeah.
So I know the team has done some analysis. The greater, if you could put it into a TFSA, not be taxed, not need to spend it, invest it and keep it growing. It's almost, you never catch up. You're going to make way more money by taking it at age 60 or 65.
And then when we look at that as well, is the break even look at it at say 67, 68 as well? Is 65 the kind of go-to number, or is it the more you can delay, the better?
That's right. It's a good question, right? So we use the age 65, just based on 60, 65 is the maximum, right? But again, not from us, but from a CPP itself, right? If you delay to age 70, you have a premium of 42%, right? And so the idea again is if you're going to live past 73 or 74, then start collecting at age 60. If you wanted to delay an additional year, obviously, say you collect at age 66, obviously you're receiving more as opposed to the maximum of 1307. Correct.
So Jeff, one of the interesting things is every situation is really unique and different. And taking the time to analyze and assess the unique features and characteristics of individuals or couples looking to ratify their retirement readiness and their capability is really what Tim and I spend a fair amount of time doing with advisors like yourself and the clients that are looking for that clarity, right? Answering that key question. So, and we can test assumptions, look at different options, see what it looks like with OAS or CPP being withdrawn at age 60 versus 65 or waiting later until 70 to see if that makes more sense. And of course, looking at the various combinations of how you apply some of the strategies that Tim talked about is interesting.
Absolutely, it is, and that's what's so fascinating about this job in particular for us, because there is so much variety and variability. One of the attendees was just wanting some clarity on the prescribed loan example.
Yeah.
Do you need to make more than 4% invested on that million to make it profitable? Does the type of growth make difference in terms of, say, you made 3% on capital gains versus the 4% prescribed loan?
Yeah, the idea obviously is to shift the tax burden from the higher income spouse to the lower income spouse. And today in March, it goes to 5% in April, right? It's at 4% currently. And so if you wanted to shift the tax burden and you also wanted an income, right? You wanted growth and an income. The idea is to have a rate of return that exceeds 4%. That's the whole point. And that spouse would receive the difference and even deduct the 4% that they are paying their spouse as interest, right? So if you were to leave it at 4%, then I'm not sure if this strategy would make sense. The only reason it would make sense, right, is that you might change your mind with respect to your investment mix, right? Goes back to a portion of your question. You know, is it interest income? Is it dividend? Is it capital gains, right, on your investment mix? But at the very least, you can write off the 4% as the person that is paying interest on an investment that you've used loan to invest in. So baseline, the 4% is a deduction. And so you receive an advantage there right away. But if you can exceed 4%, then there is a double advantage. And certainly the ultimate advantage is that your higher income spouse is not being taxed. You are being taxed and you're paying tax at a lower tax bracket.
It made a lot more sense, didn't it, Tim, when the prescribed rate was 1%?
Yes.
It was much easier, much lower hurdle rate, but
now 4%.
Yeah.
It might still work for some people, but I'd say for the vast majority of people, probably not, because you've got to work hard to exceed, comfortably to exceed 4% over the length or the life of the loan.
Absolutely. Absolutely. Well, Tim, Mark, Michael, we really appreciate your time. Your insight is very much invaluable, and just in appreciation of your time, we should probably end it off here. For anyone who's attending in the audience, feel free to reach out to Dave, Raheem, or myself. We're more than happy to answer your questions, or reach out to Tim, Mark, and Mike to get their input as well. And thanks again, and have yourself a great day, and stay warm for those in Calgary.
Thank you.
thanks, guys.